Good morning and welcome to the webinar hosted by the Investor Responsibility Research Center Institute and Sustainalytics on the new research report, How Investors Integrate ESG, a Typology of Approaches. Our agenda today is logistics and introductions, why this research was conducted. We'll do an in-depth review of the research, including the methodology, the typology, the prevailing types, market observations. Then we'll do a conclusion and take your questions. In terms of logistics for the webinar, all of the attendees are in listen-only mode, but we do encourage your questions. Throughout the presentation, if questions arise, you can type your question into the question box, and you can see that pointed to with the yellow arrow there, number 1. And we will read those questions after the presentation aloud. You also have the option of asking questions over the phone line here. So if you just type in, open up my phone line, we can open that. You can ask the question over the phone line. The session is recording right now, so we will have a replay available at www.irrcinstitute.org. That will be up by tomorrow. Of course, we encourage you to share this information on social media. Our Twitter handles are @IRC Research and @Sustainalytics. If you have any audio issues during this webinar, please call GoToWebinar at 1-800-263-6317. We have 3 speakers today. The first is John Lekumnik. He is the Executive Director of the IRRC Institute, and he's been in that role since its founding. With the Board of Directors, he's led the organization to become a leading source of objective, academic, and practitioner research on an array of investment issues. John has decades of experience as an institutional investor, including time as the investment advisor to the New York City pension funds. John also is the author of the new book, What They Do With Your Money, How the Financial System Fails Us and How to Fix It, published by Yale University Press. Also on the call today are 2 of the report authors, Kevin Rainey and Doug Morrow. Kevin is the Director of Product Strategy and Development at Sustainalytics. He has 20 years of experience in the field of responsible investment and corporate sustainability and has worked with a wide variety of asset owners and investment managers, helping them to incorporate ESG considerations into their investment policies, strategies, and processes. He's an expert in the development of metrics and methods to evaluate sustainability performance and has led numerous projects involving the development of custom frameworks and metrics to measure ESG-related risk and impact. Also on the call today, the webinar, is Doug Morrow. He's the Associate Director of Thematic Research at Sustainalytics, managing the firm's thematic research products, including ESG Spotlight, Spectra reports, and thematic notes. Doug's work is focused on evaluating macro investment themes and cross-cutting investment risks and opportunities, including those related to climate change, global energy transition, water scarcity, data security, community relationships, and corporate transparency. Before he was at Sustainalytics, Doug worked as a senior research roles at Corporate Knights Capital, ICF International, and Innovest. Just a couple quick words about both organizations. IRC, as many of you know, is a nonprofit organization, and essentially what it does is fund and disseminate objective, unbiased research on a whole range of issues that are of interest to investors and other stakeholders. It's both academic and practitioner research, and we do have an annual research award with 2 $10,000 prizes. That competition is open now, and the deadline for submissions is October 6th, so we encourage you to take a look at our website to see if you're interested in applying for an award, if that suits you. And we have more than 60 research reports available at no charge. Regarding Sustainalytics, it's a global leader in ESG and corporate governance research, ratings, and analysis. It's got 13 offices around the world with a staff of more than 300 people. It covers the universe of 6,500 global equities and has over 300 institutional clients in 22 countries. And with that, I'll turn the presentation over to John Lekumnik to give the IRC's perspective on the research. John?
Thank you, Kelly. And thank you to Sustainalytics for doing a great report. I want to take a moment to frame why this report exists. You know, for many decades, a number of us have suggested that ESG factors matter to the bottom line. And that has certainly become mainstream in the last few years. We have $22 trillion of institutionalized assets under management, which are managed according to subtype of ESG analysis. And many managers utilize ESG analysis either as a source of alpha, an important risk control. Some people look at it thematically, for instance, looking for investment opportunities around water issues, and for some, it's a deep analysis of individual companies to understand risk and opportunity of that individual potential portfolio investment. There are business reasons as well that asset management companies and asset owners use ESG. Number one, if you're an asset manager, many tenders, or what we call RFPs here in the United States, from asset owners require or ask about what you do to consider these factors. Another issue, which is very material for those in the industry, but sometimes forgotten by those outside the industry, is that younger investment professionals are attracted to firms which look at these factors, particularly younger investment professionals starting their careers. They care about these issues, and so they want to work at firms that care about these issues. All this success, though, has a very soft center, or we believed it had a soft center, that many, many investors and asset managers claim to integrate ESG into their investment process. But when they say integrate ESG, it has become literally a meaningless mantra. It doesn't really describe what the manager does. Next slide, please. In fact, ESG integration has been used as a catchphrase to mean anything from a deep analysis, taking ESG factors into account at every level of the investment process, to outright greenwashing. This is very different. When a fundamental equity manager tells me I'm a bottom-up fundamental small cap value manager, I have a starting point for understanding that manager's investment philosophy and process. Whereas if a manager just says I integrate ESG, that's not really as helpful. I have to tell you, even sophisticated beneficial owners get confused. In the last 2 weeks, I've been having a dialogue with the CEO of a $60 billion trust. This is not a small manager. And he is trying to figure out a better way to diligence managers around their ESG process, because he has been frustrated by the fuzziness of the diligence process that previously existed in his trust. So, being aware of all this, the IRC Institute issued an RFP for a typology of how managers actually do integrate ESG. The instructions were for the research provider to be very granular in its findings. Basically, I said, if I were going to start an asset management firm and I wanted to have an ESG focus, what are my options? Who at the firm should be involved? What is it that's integrated? How is it done? Next slide, please. So we hired Sustainalytics. They won the bid. It was an open tender. And I think when you read the report, you'll agree they did a good job. It's not the final word on the subject, nor would Sustainalytics itself claim it was the final word. But Sustainalytics has developed an analytical framework that is both useful for understanding exactly how asset managers integrate ESG and can be built upon in the future. This typography provides the equivalent of that style analysis, that small cap fundamental bottom-up manager type of semantic framework that enables everyone to know exactly what you're talking about. As you'll see, Sustainalytics has also identified leading styles of ESG integration: the believer, the statistician, the cautionary, etc. And while in the few weeks since the report's release, those categories have received a fair amount of attention, I think we all think that the more important contribution of the report is the analytical framework itself. Those styles are summations of parts of that analytical framework. They are not the framework itself. As a result, we can now understand how a particular form of ESG integration affects investment processes and portfolio construction. The response to the report, I have to say, has been extraordinary. In the last 2 weeks, I've received more than 100 comments on this report. Literally 99% of them have been positive. It seems I wasn't the only one frustrated by the lack of clarity on the phrase ESG integration, and I'm very pleased that the investment community recognized the utility of having a strong analytical framework with which to discuss all this. And with all that, let me turn this over to Kevin and Doug to walk us through the findings. Kevin?
Thanks, John. That sets the stage really well. And thanks to all for joining today. We are really pleased to have been able to collaborate with the IRC Institute on this project and to present the outcomes today. And we do hope that the typology will serve to clarify conversations about what ESG integration really means in practice, and to help investors navigate this rapidly evolving space. We see the typology as building on past work, most notably that of the PRI, which has produced a few reports. One recent report provides a really nice inventory of examples of ESG integration in public equity investing. In the case of this project, we have aimed to really home in on the key differentiators between the different approaches that we see in the market, while also encompassing a broader range of variables, including organizational and process-related aspects of integration, and then to use these to build the typology. It doesn't capture all of the details and all of the nuances of the different approaches, but we hope that it does identify at least the key differentiators that we see. Also want to note that it aims to identify and to classify and not to pass judgment on approaches. We're not saying what is better or more effective or leads to better results. It's really about, again, identifying and classifying. Next slide, please. So a few notes on methodology. The typology assumes the prevailing definition of ESG integration, that is the incorporation of ESG factors with the aim of enhancing returns. And a quick related note here on the practice of screening or filtering on ESG factors, which is a practice used by a fair number of investors that integrate ESG. We treated screening as a technique of integration if it is at least in part motivated by an investment case, as opposed to being motivated solely by the goal of complying with norms. Now, with respect to the scope, one significant note here is that the typology focuses on portfolio management itself and doesn't consider other related activities such as engagement, which for many plays an important role in informing their investment analysis. But we opted to really focus specifically on the structures, the processes, the methods involved in integrating ESG into portfolio management itself. So we began our process with the development of an initial analytical framework that included 18 indicators that we used to structure our research. This framework was informed by the PRI reporting framework, as well as our in-house awareness of integration practices in the market. And so we used this framework to examine the practices of 70 investors that are PRI signatories, reviewing their transparency reports and carrying out interviews with half of the 70. In selecting the sample, we aimed to include a wide cross-section of the market and diversity with respect to investor size, geography, position in the market, etc. Most of those that we looked at are focused on listed equity, but some on fixed income. Most are active, but there's a lot of passive in the mix as well. And then one final methodological note is that the unit of analysis in this study is the approach that individual portfolio management teams take to integration, as opposed to whole firms. And so what this means is that within some asset management firms, especially larger ones, there may be multiple approaches in place, and this is something that we observed. Next slide, please. So here at a high level is the typology that emerged from this process. It has three core dimensions, which in short are first, management, or how ESG-related functions are organized and managed. In other words, who is integrating ESG. Secondly, the nature of the research and analysis that is being integrated. In other words, what is being integrated. And then thirdly, application, which addresses the kind of techniques that are employed, that is the how of integration. And within each of these dimensions, we identified what we observed to be the most important differentiators among the approaches, and there are two for each dimension. So in the next three slides, I'll delve in more detail into each of these dimensions. Next slide, please. So management, again, is about how the various functions and roles related to integration are organized and managed. And the first key differentiator here addresses the degree to which these functions and related responsibilities are carried out, are centralized. And there is a continuum here, as there is with most of these differentiators. So at the centralized end of that continuum, you may see dedicated ESG personnel or specialized teams that are carrying out, for example, ESG research and materiality analysis that they then pass on to portfolio managers. In contrast, in a fully decentralized approach, there are unlikely to be dedicated roles, and responsibility lies fully with individual portfolio managers to integrate in whatever way they deem appropriate. The second differentiator for this dimension focuses on whether processes and mechanisms are in place to ensure that ESG factors are integrated or taken into account. That is to say, it's not about whether that ESG, in fact, affects the outcome of a decision, but are they at least being considered? And so this might involve, for example, a requirement that portfolio managers document if and how ESG was considered to be material and incorporated into each investment decision. So these two differentiators are independent of each other, and so a given approach can be classified in one of the four quadrants that you see in this graphic, and that's true for each of the three dimensions. So a few noteworthy findings here. We heard different views on the pros and cons of centralized versus decentralized structures. It was interesting to hear from some of the interviews that are more centralized, that while they see the role of ESG specialists as being very important, they also aim to move toward less centralization, seeing it as the way to better embed ESG into the daily work of portfolio managers. We also heard differing views regarding the necessity and effectiveness of mechanisms to ensure that ESG factors are at least considered. Some view them as important in order to ensure a consistent approach. Others see them as unnecessary and indeed assume that a good portfolio manager will figure out what's material and consider it in any case. Related to this, we also heard that creating a team culture that recognizes the value of ESG integration is probably the most effective way to ensure that it actually happens. Next slide, please. So next comes research, the second dimension. And this considers the type of ESG information analysis that is being integrated. So the first differentiator here considers the scope of the research or the breadth of the research that is being integrated. And this ranges from what we call narrow to broad. By narrow, we mean research on ESG relevant characteristics of individual companies. So these would include metrics on governance practices, on health and safety, etc. There are many such metrics at the company level. In contrast, by broad research, we mean research that includes not only this company level information, but also includes information and analysis at the macro level, say thematic trends that may interact with the company specific factors and influence value. And examples of this type of analysis would include stranded assets risk, trends around water scarcity, demographic changes, etc. The second key differentiator for this dimension is it addresses if and how inputs used by portfolio managers are modified internally. So it's the question: are data or scores that have been, say, it's obtained from an external provider, are they taken as a given, or does a team modify externally sourced data or research using, for example, an internal scoring model, or is it, say, selecting certain metrics in line with in-house materiality analysis? So a couple of noteworthy findings here. With regard to this broad research, we heard a growing recognition of the importance of considering not only the company-specific factors, but the broader trends and how they interact with the company-specific factors. And yet, in practice, at least when it comes to ESG trends, many are not, in fact, integrating at this level. We heard from a number of interviewees that it's very challenging to do this kind of analysis, to quantify the expected effects of macro-level ESG issues, especially given the systemic nature of these issues. So this is a very challenging area and very much an area under development in the industry. And then a second observation is that those that are doing a more customized in-house analysis using their own tools and frameworks, and those that have carried out materiality analysis systemically, are generally inclined to use modified inputs in order to reflect their in-house analysis and frameworks. Next slide, please. So the third and final dimension is application, which focuses on the question of how investment teams are applying ESG information in their investment process. And the first differentiator here is if and how top-down techniques are used. The second is about if and how bottom-up techniques are used. And these are separate because both can be in place. It's not an either-or situation. It's important to note here that the definition of top-down in our typology is a bit different from how it's often defined, so I'll try to clarify. Top-down integration involves the development and application of an investment thesis that it's based on a general view of how ESG factors may create investment risks and opportunities, as opposed to a company-specific view derived from fundamental analysis. So top-down techniques are most often rule-based, though they may also involve a general view of an industry or of a business model as a whole, which may affect the approach to portfolio construction. Examples of this include filtering a universe or reweighting an index based on material ESG factors. And this is something that can be applied to both active and passive strategies. By bottom up, in contrast, we're referring to integration into security-specific fundamental analysis using ESG, for example, to adjust the discount rate in a model. And there are various ways to do that. And I want to highlight here that both top-down and bottom-up techniques can incorporate both narrow research, as we've defined it, or broad research, as I explained under dimension 2, the research dimension. So to wrap up with a couple of findings here, one is that screening we found to be one of the more common top-down techniques in use. And the rationale is grounded in an investment case, though it's often seen also to have value from the perspective of mitigating sustainability impacts. And it's very interesting to see how these two rationales are often viewed as being highly aligned, especially, again, given the systemic nature of the way in which many ESG issues will affect value. And then a second finding is that the goal of, some have find the goal of limiting tracking error to be a constraint on integrating ESG, especially with respect to the integration of sort of a longer-term view on the impact of micro or thematic trends on certain sectors. So that's an overview of the typology itself. I will now pass it to my colleague Doug, who will speak to what we did in the next step of our process.
Thank you very much, Kevin. So in addition to developing the typology, we were also interested in identifying what we refer to as prevailing types of ESG integration in today's market. And the prevailing types are really an output of the typology itself, as you can see here on the slide. And our task was really to look at all the various permutations that were yielded by the typology and identify those that were not only well represented among the 70 investors that we looked at, but were also distinctive in terms of their contribution to the overall ESG integration market. So again, as you can see on the slide, we landed on 6 distinct prevailing types. And you can also see the pathway through the typology to get to each of those types. Now, as we said before, it is difficult to bucket any one investor into these prevailing types because we found, especially at large shops, they're often simultaneously running multiple approaches to ESG integration. But I think the real value add here is I think these prevailing types help shed light on important differences that investors are taking with ESG integration, and they help just generally characterize the diversity that we're seeing through our interviews with investor practices. So what I wanted to do is just briefly go over each of the 6 prevailing types. So if I can have the next slide, please. So the first one is what we call the believer. Now this is an approach to ESG integration that really involves a clear structure and a consistent approach across an entire organization. Notable features, as you can see here on the slide, are the use of top-down techniques. So again, this is taking a general view about how ESG risks or opportunities may play out in the market, as well as narrow research. So an example of what this might look like in practice would be underweighting portfolio companies with a worst-in-class ESG score, for example, bottom 5% of their industry. Now, as we'll see, like the cautionary and the statistician, the believer centralizes ESG responsibilities, and it has a process to ensure that ESG factors are considered in the investment process. Next slide, please. Thank you. The cautionary, so this is the second prevailing type. This is really distinguished by the use of bottom-up integration techniques. An example would be adjusting cash flow projections or a discount rate in a company's DCF, and narrow ESG research that's largely unmodified. So this would be, for example, overall ESG scores or individual performance metrics like energy intensity. Now, integration methods here are a little bit less systematic than those of the believer, although as you can see, the cautionary still has a system in place to facilitate the integration of ESG information. Next slide, please. So as the name implies, the statistician is really focused on quant analysis and unearthing statistical relationships between ESG factors and firm or portfolio level performance. Unlike the believer and the cautionary, this type is characterized by modified ESG inputs, which you can see there under the research dimension. Now, this means external ESG research that is augmented with in-house analysis. So for example, things like factor weights. However, like both the believer and the cautionary, the statistician uses a centralized approach to ESG management, such as Kevin said, ESG specialists who sit outside or within investment teams, and it has a process to ensure integration. Although, as with other types, there can be a lot of variation regarding the specific type and extent of these processes that fall within this approach type. Now, the statistician is also noteworthy in that it's likely to encompass most passive managers. So if I can have the next slide, please. So the discretionary, this prevailing type is unique among the six because it's the only one that lacks a process to ensure or encourage the uptake of ESG research into investment decision making. So you can see this under the management dimension on the slide. And coupled with the use of unmodified ESG inputs, an application that's neither focused on top-down or bottom-up, this type just generally reflects a lack of conviction about the financial value add of ESG integration. So teams taking this approach usually, for instance, don't have like an overarching organizational view on how ESG factors may affect value. And PMs and analysts under this prevailing type usually have a lot of latitude in determining the relative importance of ESG information and whether to use it at all in the investment process. So the next slide, please. The transition focus. So in many ways, this is the polar opposite of the discretionary. So hallmarks of this type include decentralized ESG management, the use of broad ESG research that is modified with in-house data and analysis, and a combination of both bottom-up and top-down integration techniques. So practical examples would include a structured assessment of macro themes like water scarcity or climate change or the shift towards healthy eating, for instance, or underweighting fossil fuel companies based on stranded asset risk. Now, this characteristic lives below the typology in some ways, but generally speaking, approaches that fall into this type are really associated with a high degree of conviction on the part of PMs and analysts about the potential of ESG information to add investment value. And we find that ESG is often a central part of a firm's culture for approaches that fall into this type. So we can move to the next slide, please. Thank you. The final of the six prevailing types is what we call the fundamentalist. So it's really broadly similar to the transition focus, but it's distinguished by greater emphasis on bottom-up techniques, as you can see there on the slide to the right. So examples would include scenario analysis to forecast possible outcomes of ESG controversies like pipeline spills, or considering how companies stand to be affected by the prospect of carbon pricing, things like that. Now, along with the transition focus, this is the only prevailing type where ESG responsibilities rest with investment teams as opposed to a dedicated ESG staff. So just to summarize and reiterate what we've said before, not every investor will fit perfectly into these 6 prevailing types, because the typology, like any analytical framework, involves a simplification of reality. But our hope is that these tools provide a new vocabulary to help the market make more informed sense of how investors are approaching ESG integration. So for those of you who have seen or read the report already, you'll know that we closed out the paper by offering 5 high-level observations about the general state of play of the market. Now, not all these observations are expressed in the typology or the prevailing types, so we really just presented them as general findings from our research and interviews. And I'll just briefly summarize each of them now before we can turn to the Q&A. So the first one is simply that it's actually quite difficult to know precisely how much ESG integration is actually going on. And what we mean by that is it's partly due to the lack of conviction about the risk and return benefits of ESG information on the part of individual investment decision makers, including PMs, at organizations that have expressed support, outward support for ESG integration, for example, by becoming a signatory to the PRI. So, coupled with what we found in our research, with a lack of reporting mechanisms at many organizations that require PMs and analysts to show, precisely how ESG factors were or were not considered, it's really clear that many investment teams are not fully utilizing the ESG research that they have access to. But on the other hand, it's also possible that a lot of genuine integration is taking place at organizations that have not expressed support publicly for ESG integration, again, by embracing the PRI. So I guess the takeaway is really, depending on how high one sets the bar, it actually is quite challenging to determine how much integration is actually going on. So the next observation, this is a second finding that came through our research, is simply that meaningful ESG integration it can still be quite difficult. Despite, as John and Kevin both said, despite the surge of investor interest in ESG and the significant growth in global AUM, many interviewees said that genuine integration can still be challenging. And many singled out in particular the practice of bottom-up techniques. So again, things like adjusting a company's projected cash flows or discount rate based on ESG. Now, again, in the report, we definitely identified many innovative examples in terms of embedding ESG in bottom-up techniques, but I think our takeaway here is really that this type of analysis is really at an early stage in the life cycle. A third high-level finding is simply that concerns about ESG research were fairly widely documented. Many of the investors we spoke with signaled a concern about research timeliness, transparency, and geographic coverage, especially for emerging markets. Now, of course, many of these concerns reflect the relatively brief history of corporate ESG disclosures. And many investors in the interview process also cited a notable improvement on many of these measures in recent years. But I think, overall, this does underscore the importance, in our view, for the users of ESG data to, triangulate performance data where possible, or corroborate different, types of ESG scores. A fourth observation, this picks up on some of Kevin's comments. It really relates to tracking error constraints. It was actually quite interesting. It was definitely a recurring theme. Many managers that we spoke with indicated that tracking error limits set by asset owners are in many ways constraining the extent to which they can incorporate ESG information into their portfolio strategies. And it's similar in a lot of ways to the long-time complaint by fundamental managers that tracking error limits mean that investors want active management, but not too much active management. So there's an interesting parallel there, I think. So to us, this means that more empirical testing of ESG investment products may be required, including expected impacts on volatility, portfolio volatility, before such constraints are relaxed. And then a final high-level observation. Again, this picks up on what Kevin said. For many investors, the line between, on the one hand, maximizing risk-adjusted return, and on the other hand, minimizing corporate, social, and environmental impacts, the line is really blurring. For instance, many interviewees talked about an investment case for aligning their holdings with the broader goal of creating a sustainable economy, particularly in light of renewed talk about the importance of integrating a systemic perspective into investment decision-making, as expressed by a number of different outfits, including the Investment Integration Project. So that really concludes the 5 high-level observations. If we can just go to the next slide, please. I just wanted to close out by saying once again that we hope the typology and the prevailing types that we discussed today in the webinar, we hope they provide a flexible analytical framework that investors and other stakeholders can use to help organize the diversity of approaches to ESG integration that we see in the market. We also hope that the study promotes a discourse and discussion and provides clarity about what we see as the essential features of ESG integration techniques. And again, as John said at the beginning, as the space is constantly evolving, it'll be interesting to see over time if there's a market shift in these essential features, and it's something that we intend to monitor. So with that, I'll pass it back to Kelly, and we can moderate the Q&A.
Thanks, everyone. So now we're on to the Q&A portion of the webinar. So if you have questions, you can see a question box on your control panel. Just feel free to type in your questions there. We'll read them aloud, and John or the authors will respond. And if you do want to have a conversation with the authors, just type in the question box, open up my phone line, and I can do that, and you can ask your question directly. So our first question is, does your framework accommodate both passive and active managers?
Yeah, I can take that one. So yeah, it is very much our intent it was our intent to create a framework that accommodates both. And so I'll start with dimension. I'll speak to the 3 dimensions briefly on this. It's in the 3rd dimension, which is, it has the top down and bottom up differentiators. It's in that dimension that the defining characteristic of a passive strategy lies, and that is that it's very much a top-down, rules-based approach. Now, interestingly, in the 2nd dimension, which is about the type of research, narrow or broad, and whether it's modified or not, a passive strategy could be in any of the 4 quadrants there. It could be based on broad or narrow. It could be built on modified or unmodified research. And then in the 1st dimension, it's fairly clear as well where passive strategy would lie, and that it is in effect a centralized process that the portfolio managers that are building an index that has an ESG focus of some sort or integrates ESG. And in effect, there is a process to ensure that that integration does take place. So it's really in that middle dimension, the 2nd dimension, that we see variation among passive strategies. To speak in terms of the prevailing types that Doug described, most passive strategies would be either the statistician or the type that we call the believer.
Thank you. Our next question, I can take this one. Where can we find the report online? It's posted on the IRRC website. That's www.irrcinstitute.org. It's on the home page, and you can also click on the research page, and it's the first report listed there on the research page. I believe it's also posted on the Sustainalytics website. Kevin and Doug, I don't know if you know exactly where that is on the website. I'm sorry, I don't know that, but I believe it is on their website also. The next question, in terms of bottom-up integration into financial analysis, which seems to be more in line with the UN PRI definition, what is your estimation of the amount of assets and or asset managers that are actually doing this?
Yeah, interesting question. We don't have the answer to that one, I'm afraid. I mean, in this process in general, our aim has not been to quantify the in terms of assets, the degree to which each of these approaches is in place. Our aim has really been to identify key differentiators and classify and create a tool that we hope will be useful to the market. But yeah, that's a question we just didn't set out to answer.
Thank you. Our next question. The typology of approaches to ESG integration is very interesting. How can we use it to help us understand the effectiveness of the different approaches in achieving financial goals? For example, lower risk or enhanced alpha, or environmental and social goals, for example, lower emissions or reduced human rights abuse.
Thanks. I can take a crack at that one, and Kevin, feel free to jump in if you have another perspective. Again, I think it will be difficult to use this typology or the prevailing types to support those types of assessments. I think, I mean, that's certainly something that strikes me as a potential other research add-on to this project. As Kevin said in the beginning, we really wanted to stay away from imposing any type of judgments about the effectiveness of the prevailing types or the different differentiators. So I think my summary is that I think it would be hard to leverage this type of analysis to make informed judgments about the effectiveness of the approach.
Hi, it's John. Let me suggest a couple things that can be done, though. In any sort of due diligence on managers, what you're looking for is consistency and divergence. So, for instance, the question about systemic impact, if there's no process to ensure integration and there's no reporting back, it's that the manager just isn't even paying attention to the systemic impacts. So in the extreme case where there's no reporting back and no process to ensure integration, if that is your particular key highest utility function, you may or may not want to choose that manager. So I think that what this does provide is not necessarily a roadmap to which of these, as Doug said, it doesn't provide which of these types is most impactful or least impactful, as you may want to be, on the environment. But it does suggest, in effect, an internal roadmap to being consistent and therefore one would think more effective in applying the manager's own choice of techniques. So if someone says they do one thing and then in your due diligence you find out it is not being done or it's being done consistently, you could make certain inferences. If it's not being done, the chances of success on either the financial or systems level goals is probably less than if it is being done consistently.
Thank you. Our next question, based on the sample size, can you comment on which typology is the most prevalent currently?
I can answer that one. No, that's certainly a question that's come up a lot, to us as authors. It's just not something we did in the report, and the reason why, there's a few reasons. One is it really comes back to what we said earlier, where we found that especially at the larger shops, many investors are simultaneously running different approaches to ESG integration. So the unit of analysis for this study was an individual approach to ESG integration that portfolio teams are taking. So that creates a bit of disconnect in terms of lumping investors into any of the prevailing types, and then by extension, it makes it difficult to size the market, so to speak, using those 6 prevailing types. And then another point is simply the research, especially with the 35 investors that we did not interview and use desk-based research. We did find a fair number of research gaps, so that also made it difficult for us to bucket them into any of the 6 prevailing types.
Kevin, can I just ask you a follow-up question on that, though? There do seem to be a number of high-profile, multi-billion-dollar index mandates being issued lately. For instance, low-carbon indexes from both New York State and CalSTRS. I think when you aggregate those alone, they're over $4 billion of the 22.9. So do you see that as a more recent trend? And I guess, again, without looking at those specifically, they, as you said earlier, the sort of passive quant view would fall into either a statistician or a believer. So do you see that as a more recent trend as opposed to the traditional bottom-up active management, not bottom-up in your sense, but I guess it would be narrow research, specific research in your sense? Is that more of a trend recently?
Yeah, I can offer a view on that. Yes, it is. I would agree with that. And it's interesting that in some ways that speaks to how we went about selecting the prevailing types, and why did we decide to focus on these 6? And I think what's interesting about what you're saying is we actually found, with the statistician, even though it was, among, relatively well represented, it wasn't as well represented as the others. But the reason we wanted to include it was simply because of the distinctiveness factor. So we said before there were 2 factors that went into the selection of the prevailing types. They had to be generally well represented, but also distinctive. And as you said, due to the trend in the asset management industry away from active towards passive, and then also with the quant, the uptick in quant strategies, a lot of these approaches are going to fall into, as Kevin said, the statistician, and maybe to a slightly lesser extent, the believer. So yes,
there also there may be fewer such mandates, but they tend to be multi-billion. They're very large mandates, so they're important.
Yeah, exactly. There's also the size to consider. Yeah.
Thank you, gentlemen. Our next question, did you observe clear geographical differences? For example, EU investors versus US investors?
I can share one thought there, and that is that in general, we heard that European investors are more likely to be making use of a top-down strategy, or incorporate top-down techniques into their approach based on a combined rationale of a belief or recognition that certain ESG factors are likely to have an impact on value in the long run, but that combined with the view that it's a good idea to mitigate the impact that may be associated with some of these factors. So, in other words, filtering out companies that have are involved in major controversies or that have very poor overall ESG performance. So Doug spoke to this blurring that we see in the market, that connects to those concerns over sustainability impacts. And again, that's something that we saw more frequently among the European interviewees. Having said that, one needs to be careful that it's not a huge sample size, but that is an impression we came away with.
Thank you. Our next question: how can a small active fund manager making first steps in this market use your typology approach to inform its ESG integration strategy?
I'll take this and then I'll give it back to you guys, because that was really my instruction to Sustainalytics when we first met after they won the bid, was write this so that if I were starting an asset management firm, I would know what to do. So I think you have to decide on what your philosophy of why you are doing this is. And when you do, then you can start thinking along the dimensions. So combined with reality. What I mean by that is, for instance, let's say you think that the best way to integrate corporate-specific ESG research is at the portfolio team, because then it's totally integrated into in the centralized, decentralized, totally integrated to your investment philosophy. Well, you have to be able to find investment professionals who can do both fundamental analysis and ESG analysis. And then you need to make a decision as to what it is they're integrating. So if you're buying research, are you going to take it as is? Are you going to buy multiple sources? Are you going to modify it? So I think that if you just walk along the dimensions here, you can try to develop an investment process that is consistent with how you believe ESG affects your risk return profile of your overall portfolio, and whether or not you want systems impact. So to me, that is one of the most useful ways this can be used. It is also useful, I think, for existing investment managers who, the way this business works, sometimes things just develop over time, and to take a step back and say, we have developed according to these dimensions. Is this really what I want? And is it what I want for a future state? So it's a way that you can have I'm going to say checklist, but not an unintelligent, just tick the box checklist, but a set of reminders to say, are there holes in our process? So I think that's actually one of the more useful ways that this report can be used.
Thanks, John. And as we approach the top of the hour, it looks like we have one last question in the queue. Are the ESG integration styles very natural to AM organization, asset manager, I guess that means? If an organization runs a centralized top-down investment process and likes the numbers, aren't they a statistician by nature and not by choice, like the report seems to imply?
Sorry, Kelly, we didn't quite follow that question.
You want me to read it again? Or are the ESG integration styles very natural to asset manager organizations? If an organization runs a centralized top-down investment process and likes the numbers, are they a statistician by nature and not by choice, as the report seems to imply?
Gentlemen, I think what they're saying is, does your overall investment philosophy dictate your ESG integration implementation? And I guess in the case that they're citing, my answer would be probably. I don't know that it's by nature your overall investment philosophy is a choice to begin with. So it may be what you are most comfortable with and what you believe, but if you are looking at ESG integration, remember we started this, Kevin and Doug said this was designed to be for firms that are integrating ESG based on financial and systemic results, not for investors who make fundamental ethical decisions, and that is the purpose only or solely. So if you are a believer in what drives risk and return overall, you probably believe the same about ESG factors. They are, after all, risk and return factors.
And yeah, that looks like that concludes our questions. And if you had additional questions, follow-up questions related to those, of course, Kevin, Doug, and John are available to discuss in more detail. As you can see on the slide here, here's their contact information, email and phone numbers, and they'd be happy to field any additional questions you might have. So this concludes our webinar for today. We thank all of you for your participation. This session was recorded. This recording will be available by tomorrow on the IRRC website, as will these PowerPoint slides. And just as a reminder, we are hosting this session 2 more times today. If you're interested in participating again or forwarding information, they will be at 1 o'clock Eastern Time today and 8 o'clock p.m. Eastern Time today, both of those to accommodate U.S. and Asia investors and interested parties. So again, we thank you for your participation, and we hope that you have a nice day and week. Thank you.